questions we received from you during the webinar, so please type them into your console's Q&A window anytime during the session. You can also download the presentation materials using the Downloads window at the top of our console. I'll now turn it over to Charles Luke of City National Rockdale.
Great. Thanks a lot, Rachel. I appreciate the introduction. And I just want to thank everybody for hopping on before the Labor Day weekend. I'm sure that you've got plans out there, so we appreciate you spending some time with us. So we've got a great lineup for you today. I'm going to kick us off as usual with some of the most salient topics that we see out there. Paul's on to walk us through much of what's happening with the Fed and get deeper into the economy. And then I'm really excited to have Joe on to really launch our new thematic equity classifications that we've been working on in the lab for a little bit of time. So I think that'll be a treat for us going into the weekend. So what you'll see on this page, as we always do, is we walk through our speedometers. I don't want to spend too much time here today, but I do want to make a few key points. Our adjustments for the month of August did not come out before the last webinar. So I'd encourage you to watch the speedometer video that's going to be coming up next week. It's going to have our updated view, but I did want to give you all the highlights. So the bottom line is that we're pretty optimistic here at the margin. We do have some positive economic surprises. That's just comparing forecast to actual results. They've been looking pretty good, hooked up sharply here lately. A lot of the current activity indicators that we watch that just shows sort of the lifeblood of the economy, those are strong, really indicating GDP growth above about 2% in Q3. If we look at the revision that just came out today for Q2 GDP, it was revised up from 3.1 to 3.3%. So things are looking pretty strong from those measures. Financial conditions are at their most positive since 2021. So credit's available in the economy. The grease for the economy is alive and well and moving through the system. And then we're at all-time highs in the market. So something has to be going right for us to be here. This is at a time when spending is slowing in the economy and Fed policy is still restrictive. So to be at this high usually means that the economy is doing just fine. And we certainly think that's the case at this point in time. Now, we certainly do have some concerns around the level of equities, and tariffs certainly remain an issue for us. So we're not all sunshine and rainbows here, but there are several mitigating factors that have come into the market here recently that offset some of those concerns, the strongest of which is going to be Federal Reserve rate cuts. So we do see the economy going forward performing at an aggregate level that's a little bit better in 2026. We think consumer sentiment is going to be better over the next 6 to 9 months. And the impact to interest rates from Fed policy is likely to be positive as well if we look 6 to 9 months out from today. So keep in mind that credit is still very widely available. Consumer spending has slowed this year, but it's still moving at a decent clip overall. And we're going to see some economic benefit as we move into tax season at the beginning of 2026. So while I still think there's a very real risk to see some market volatility between now and the end of 2025, we do expect to see a nice start to the year in 2026, and we'll start putting our forecasts out there on the next webinar for that in September. So moving on to our economic forecast, they're a little changed from last month, but we did move our GDP growth target up slightly, generally in line with consensus, but we had a low end of about 1%. We've moved that up to 1.25%. As far as corporate earnings, we just finished another great earnings season, but it did slow down from the prior 2 quarters. It's still solidly within our range, but I will talk through some of those numbers here in just a little bit. On the inflation front, we remain out of consensus, so we think inflation is going to be a little bit elevated over what we see from most economists. I think the context here that's important to note is that inflation has averaged about 2.9% since 1983. So we're right on the average with where the numbers are coming in. And some of the tariff pass-through that we are seeing is being offset by some weakness in housing prices that have started to filter through the system. And that's especially an offset to goods prices. So we do still see inflation elevated relative to the Fed's target of about 2%. But as the picture becomes a little bit more clear here, I think the inflation boogeyman might actually stay in the closet, at least with respect to the market impact. So we do see the risk of elevated headline numbers into the end of the year. Consensus keeps coming down below 3%, and we think that's a bit of a mistake. So we're expecting inflation to be a little bit higher. The one thing that we do know is the Fed is going to cut in September. So if you look at our Fed funds target and you take a look at employment and a lot of what Jerome Powell said last Friday at Jackson Hole, it's pretty clear that we're likely to see a cut in September. But we're not sure just how many more cuts we're going to see. We've had one to two for the most of the year. So we're kind of keeping that range of 2 cuts as we move into the back half of the year. And then on our 10-year forecast, with Fed cuts in view, the sub-potential growth, so still sub 2% this year, an inflation picture that's probably a little bit better than feared. For the first time in a long time, we do see the probability of longer-term rates maybe falling below 4%. So the 10-year right now is in the middle of our range between 4 and 4.5. So we're going to stick with what we have for the time being. But don't be surprised if we do move the range down a bit over the next few months. Now, this seems like a bit of a distant memory to go back to Russia and Ukraine. It was only 2 weeks ago, and it certainly garnered a lot of the headlines, but it's been completely absent after that week. But I do want to talk about this because I think it's one of the potential tailwinds in addition to Fed cuts that could be positive going into the end of this year. A potential resolution here would be very positive for the markets. So when we analyze exactly where we are in the conflict, Russia and Ukraine still could not be further apart in their views. So if you look at the left-hand side here, Ukraine does not want to cede any territory. Russia wants a big majority of the south and the east of Ukraine. NATO certainly remains an issue, and Russia is still frustrated by US and European aid support. And then if you look at Europe and the US, they also have some different perspectives. So Europe is clearly more cautious in their approach. They do want more security in the region post-resolution. And the US is essentially just acting as a broker at this point, in our opinion. So whatever ends the war seems to be okay with this administration. Ultimately, the US does want less involvement, so no NATO in Ukraine, and they want Europe to fund the majority of aid, which they are at this point. So there's a little bit of an unclear picture here. And this is all complicated by what's indicated on the right-hand chart, which is that with the conflict itself, Russia's starting to do a little bit better, and the odds are shifting in their favor. So it doesn't really look like they have to compromise. So a lot of stalemates here, but regardless, I think having the negotiations is a strong sign that resolution could happen. It seems like there's the will there. So again, we think this is another item that investors need to be watching very closely. And as far as market upside, we do see this as one of the things that could create some additional momentum going into the back half of the year. Now let's talk about the Fed for just a second in terms of the market impact. Paul's going to address some of the larger issues going on with the makeup and the administration, but I just want to focus on the potential impact to stocks and bonds. But as I discussed, the Fed's going to cut rates at their September meeting, even if unemployment seems to bounce back a little bit. And the blue bars on this indicate the probability of a cut in September. The dark blue is the expectation for where the rate would be at the end of the year, which is implying just about 2 cuts within our range. So the most important thing to do is we got new information last Friday. So the outlook for the Fed changed. So let's do a market litmus test. What's going on? Small caps are rallying substantially. They've climbed about 7.5% now in the month of August. That's outperformed the S&P 500 by over 5% and Europe by over 4%. We had a huge up day last Friday in the S&P after Powell's speech, and then value stocks are having a nice little run here too as well. I also don't think all of the monetary stimulus, the cuts that could be coming, are priced into the market yet either. When I look at Fed fund futures and sort of assess where the market is, I think it's pretty measured in their expectations. So any dovish commentary that we get at the meeting is likely to create an even bigger tailwind going into the end of the year. So I think it's a massive positive for us. Now, certainly with the Fed's actions here, there are risks to inflation, even if unemployment does deteriorate further. But as discussed, I think the housing price direction, so those prices moving a little bit lower, is helping to offset some of the increases that we're seeing across goods. And we need to be very, very careful with how we respond to inflation. Because if it does rise to our target, that's north of 3.25, we expected that to happen. So we can't immediately correlate that to the Fed if the Fed cuts. What I do think is that the market could take that as a bad sign. We could have a bit of a downdraft initially, and that could create an opportunity for us on the allocation front. But ultimately, if you step back and look at cuts, Fed cuts are generally good for the S&P 500, even better for small caps and value, and other rate-sensitive sectors like financials, real estate, and utilities. So this could keep the rally going. Now, I've already talked a lot about inflation, so let me give you some data to back up our views. If you look at the left-hand side first, let's look at PPI final demand. What we're referring to here, it's just the prices that are paid by businesses, governments, and consumers for goods and services that are ready to use. So these are finished goods and products. What happens with final demand is that it tends to rise in real time alongside of inflation. We call that a coincident indicator. And that makes sense because it's technically upstream of consumers, right? You have producers facing these prices in their production cycles. So we know that it's moving up. If you look at that left-hand side, we got a pretty big spike in July. At the same time that consumer inflation is still barely budging. And so this means that consumer prices are likely to have some of that updraft. So we do expect them to move higher. Maybe not as much as producer prices. It tends to be a much noisier series, but it will be going up. So again, we have to keep this in context. Now that we know it will likely move higher and there's signals in the market telling us that, I do think the market probably gives it a little bit of breathing room. With 3% inflation that isn't running away from us is very different from the 2022 style inflation that was feeding on itself and really became a trend. So the tariff impact itself will fade if you isolate it towards inflation, unless tariff rates keep moving up, but we don't see that at this time. So the key for us with inflation is to observe it, to assess it, and then to decide. I don't think front running any movement higher within our range is something that we want to do. I think the market already has a lot of that information and it's priced in. The other thing to offset the tariffs is that despite everything that's happening, if you look at measures of goods flowing through the economy, and this particular page shows trucking, and that can be used as a measure of activity, it's actually running above levels that we saw in 2023 and 2024. Now, excluding one-time events like the pandemic, but it's pretty much, if you look at the left-hand side here, just above the average going back to 2014. So the point is that it's very healthy out there. Consumer demand is still present. Goods are still moving through the economy. And I know some of this is inventory build, but that's not necessarily a bad thing either. So if the tariff impact because of inventories and having goods on hand can be smoothed out over a longer time frame, it gives the market less of a reason to react negatively. So activity does remain high. The other component of inflation that I wanted to talk about was the absorption. So I showed everyone this chart the last time we got together last month, and I wanted to update you on the changes that have occurred since then. So if you focus on the right-hand box, what these numbers reflect is the actual price increase observed across these goods by exporters, by retailers, and consumers. So a negative number here means lower prices. A positive number means higher prices. And what's changed between July and August is that clearly consumers have been absorbing more of these tariffs, especially with respect to household appliances, to toys, and to video and audio equipment. So again, we're going to continue to see this trend of pass through to consumers. I think this is continuing to build. So we should be expecting the next CPI print to come in above a 3% level. I think that is very likely. But we also need to remain focused on the fact that tariffs are not one-to-one. So there is a chain here, and the costs are going to be borne throughout the entire chain. So shifting over to the markets a little bit, I wanted to start with some positive and negatives here on the equity side. So stepping back, looking at earnings were great in Q2. They grew at about a 10.7% clip versus expectations of just 2.8%. And that's a pretty low bar. And we talked about this over the past couple of months. We felt like analysts were getting way too pessimistic. So we did expect heavy beats. That's exactly what happened. But if you look through that number, a couple of things are going on here, which isn't necessarily a positive. We did experience a deceleration in the level of earnings. So if we go back to Q4 of 2024, they grew at about 14.3%. If we look at Q1 of 2025 and this year, it grew at 13.6%. So at 10.7%, it's still elevated above its average levels, but the direction, the travel is lower. And on top of that, if you look at the right-hand side of this graph and we flip to net income margins, they're flirting with a peak as well. And I do think there's the potential with some of the tariff pass-through that that's going to come down a little bit. So if you look at these green half circles here, the previous peak was around June of 2021. And Q1 of 2025, if we look at the same numbers all the way to the right hand of that graph, could be the recent 2025 peak. So on the surface, I don't think this is terrible. 10% earnings growth is nothing to sneeze at. Markets did rally in 23 and 24 below the 2021 margin peaks, but downdrafts in margins do tend to be associated with some market pullbacks. So we need to stay vigilant on that front. Now, in this environment, I do think that's offset by the strong economic environment. And of course, we're going to get Fed rate cuts here in September. But again, it is something that we're watching. So in the past, I think on the past two webinars, I've talked a little bit about the potential to reduce some of our equity exposure, but the small cap trade is working for us for the first time since around November and December of 24. And I do think there are plenty of catalysts out there to help support a continued climb in the S&P 500. So all in, I'm glad that we've waited a little bit before making that decision. So we're going to stay the course there for now, but we'll continue to be attentive to the inevitable increase in risk as markets do continue to break to all-time highs. Now, moving on to the bond market, things here are also going pretty well. So if we just step back and take the past 20 years into account, post-pandemic, getting higher rates means higher returns. And it also mathematically means more stability in the portfolio from your fixed income positions. So if we look at returns this year for US fixed income and bond markets, they're generally up about 5% on the taxable side. Now, municipal bonds have struggled a little bit, but they've made a recovery here lately. So depending upon where you own those bonds, the maturity of those bonds, you're up this year anywhere between 2 and 4% on a tax-free basis. So what we've done here is we want to know what's going to happen for the next 6 months, or what's going to happen if the Fed cuts rates in September. So if you look at this graph, we've taken a look at different Fed scenarios and then corresponding moves in the 10-year Treasury rate. So if you focus on the left side first, this is a scenario analysis projecting what could potentially happen over the next 2 months. So if we see a cut, investors are looking at a potential increase of returns of between 2% to nearly 4% just over that 2-month period. And if we look at the right hand of that vertical line, over the next 6 months, 2 cuts could result in a return of 4% to almost 6%. And that's in addition to the 5% or so far that we've earned this year. So I could easily see the fixed income markets in the high single digits, and maybe even in some areas of high yield, breaching that 10% level. So bonds did have a bumpy start to this year, but they do look poised to significantly be additive to overall return. And this, again, is the benefit of higher rates, better returns, lower risk. So now we believe that bonds in a portfolio are a much more effective tool today than they have been in quite some time. So just to summarize on my thoughts, taking you through this, if we look at what the economy is doing, despite lower than expected pace, sub 2% than when we started the year, we do have some key indicators that are showing promise for the future. So we're getting a little bit more bullish on our outlook across the speedometers. Now, a potential ceasefire or potential peace agreement between Russia and Ukraine, we think that is a big factor. Again, it's not being widely discussed anymore versus 2 weeks ago, but we think that US and European leaders could facilitate an agreement here, and that could definitely have a positive impact on global markets going into 2026. On the inflationary front, we still see things rising a little bit. We are seeing it today in producer prices, and that's going to be passed on to consumers. But as far as activity, the flow of goods in the economy, it's still healthy, and it is outpacing the previous 2 years. And overall, if we think about tariffs and absorption, economic activity does remain healthy, but it is clear that that absorption is starting to be borne more by consumers, and they're shouldering much of that cost, and we're likely to see that over the next few months. And then from a market perspective, the S&P 500, as Joe talked about on the last webinar, is nearing our year-end targets, and that is prompting us to really exercise some caution here based on high expectations, the earnings picture that I talked about, and then a potential peak in margins. But we do think FOMC cuts could help to offset these concerns. And then with respect to the bond market, ahead of the September Fed meeting, if we do see a cut, that could be a medium-term boost here to fixed income returns. So all in from a market-based perspective, things are a little bit lofty, but going into September for these Fed rate cuts and really listening in to the Fed's plans and their view of the economy is going to be critically important. And we think it's going to be a positive overall for the markets. So I'll stop there and I can hand it over to Paul.
That's great. Thanks so much, Charles. And thank you all for joining us today. I do appreciate the fact that you're spending your time before the long weekend. I'm going to start talking about the Federal Reserve. There's been no shortage of news articles regarding monetary policy or the Fed's independence. So we'll take on a couple of those comments and issues there. In terms of monetary policy, the chart on the left, the columns show what the Fed says their plans are for the federal funds rate for both this year and next year. That's in the columns where they expect 50 basis points this year and another 25 basis points next year. The dark blue line that you see there is the market's expectation based on the Fed funds futures. far more dovish than what the Fed is, and that's not surprising, nor is this new news. It's the same sort of trend that we saw back when the Fed met back in June. But the markets have become a little bit more dovish in terms of their views of monetary policy. And that really has to do with the fact that when Chair Powell spoke at Jackson Hole last week, he did talk about the fact that the Fed is starting to change its views in terms of what's required of them. You know, they have that congressional mandate to keep the unemployment rate and inflation low and stable. And their focus has been really that of inflation. But it is starting to shift over towards labor. Although the labor market is quite strong, and I'll get into that in a moment, there are some concerns. You know, inflation tends to move slowly. It slowly moves up, it slowly moves down. But with labor, once a few companies start to have layoffs, it tends to snowball very, very quickly. And that's what the Fed wants to stay away from. The other thing that Powell talked about is the monetary policy framework that the Fed has. Now, just a little bit of history on the Fed. Back in 2012 is when they came out with the target rate of inflation of 2%. That's what they want. Most central banks of the world had already done so, but the Fed finally got around to it. The chart on the right, the shaded area, just shows 2% growth annually from 2012. Then in 2020, the Fed said, you know, what we're going to do is every 5 years or so, assess whether we're doing a good job or a bad job and whether our goals are correct in what we want for the economy. So when they met back in 2020, you can see inflation, whether you want to look at CPI or core PCE, was trending below the 2% rate. You know, Fed funds were extraordinarily low. They were down near zero, and the Fed just couldn't get inflation up above 2%. So the Fed came out and said, well, we're going to average around 2%, a little below for a few years, a little bit above for a few years. That will be okay. Then we had the pandemic, we had the surge in spending, the shortages and so forth that pushed up inflation. And you can see how both CPI and core PCE moved well above the long-term trend rate of 2%. So when they did their review this year, they said, no, we're going to move back to a target of 2%, and that will be firm, not around 2%. Long-term, that's somewhat hawkish compared to where they were beforehand because they want to have a 2% target, but that won't interfere with what the Fed is planning to do this year. As Charles mentioned, the probability of them cutting rates in September of 25 basis points is quite strong. Last year, they cut 50 basis points at the September meeting when they had poor labor reports in the summer months. We probably don't expect that to happen, mainly because the only reason why they would do that is if we had a really, really bad jobs report in September. So the probability of that we hold is extraordinarily small. We continue to believe that the Fed will cut once or twice this year. We've had this view for about a year for either a total of 25 or 50 basis points. In terms of the Fed's independence, the Fed was structured to be highly independent. That was one of the major goals that was set forth when it was established in 1913. In terms of the Federal Open Market Committee, the group that determines monetary policy, that's made up of the 7 members of the Board of Governors, along with the 12 regional presidents. For those that can vote at any given meeting, it's the Board of Governors, the 7 of them, plus the New York Fed president, plus 4 other regional presidents, and they have a 1-year term that rotates. Fed governors have a 14-year term. Their new one comes up every 2 years. And the chair of the Fed, along with the vice chairs, those are 4-year terms. All of those have to be nominated by the president and approved by the Senate. The 12 regional presidents, those are determined by the member banks in that region. So there's a great deal of diversity. They have a 5-year term that can be extended if needed. So it is quite diverse. This chart, this comes from data that Bloomberg calculates in terms of whether a member is either dovish or not. So that it's mainly a reference point for you in terms of when you read an article and if some Fed policymaker is making a statement, you can first see, are they voting members or non-voting members? And you can see whether it's consistent with what their views have been in the past, or if it is something different. But in terms of the labor market, I think the headline explains it all. No hires, no fires. That's what's going on. The demand for workers at this pace of economic growth is being met with what we have right now. So businesses are not eager to be hiring more people. Growth this year is somewhere around 1.5% so far, much lower than what we've been averaging over the last few years. So there's not a strong demand to be hiring more people. Thus, the changes in payroll, you can see in this measurement here, is at the lower end of the spectrum of what we've seen in the past 20 years or so. But all the other measurements, these deal with the strength of the market and in terms of keeping employees or lack of laying them off. You can see that these numbers are all at the higher end of the spectrum, showing that the demand for workers that we have currently remains quite high. Again, the economy is growing fast enough to need a certain amount of workers, which we have. But the uncertainty is there in two parts. One is the fact that there's a great deal of uncertainty by businesses in terms of the economic outlook, mainly because you've had the budget issue going on for next year, along with the fact that we're dealing with tariffs, and there are uncertain costs to an awful lot of businesses. That's still there, but that is moving its way through, and an awful lot of those have been determined. The level of inflation and monetary policy is something that's a concern, but not a major concern for businesses right now. That path seems to be pretty stable in terms of the view. The other issue is artificial intelligence. How much of a productivity gain will you get out of that? Do we need to be hiring young college graduates at this time to do stuff that maybe AI can do? Well, that's a bit unknown. And combine that with the uncertainty, that's what's keeping payroll growth on the slow side right now. But our view is that the economy will be much stronger next year, mainly because the Fed will be cutting interest rates. A lot of the uncertainty will be behind us in terms of the economic outlook, and we should see much stronger growth. Another issue that's going on that's consistent with what I was just talking about is that consumers have been sitting on the sidelines. This is one of the major reasons why economic growth is slower this year compared to what we had seen last year. On the left-hand side, you can see the consumer spending numbers that come out each month at the end of each month. And this is what feeds into the consumption component of GDP. The columns are the monthly change. And you can see we've had 2 months of weak growth and one month of negative growth. And that has pushed down the 3-month average on this at a rate that's much slower than what we have been at in the last few years. People are concerned. The thing is that the cutback in the spending is not because they don't have the means to do so. It's because of a choice. It's the uncertainty. Why be buying things if we're uncertain about the future? And so that's a major concern. But what we're seeing is what consumers are doing. You can see on the right-hand side, this is measuring revolving credit. Revolving credit, this data comes out monthly, unlike credit card data that's quarterly. But revolving credit is money that you can borrow and pay off and then borrow again. So it is like a credit card, a line of credit, a home equity line of credit. 92% of revolving credit is credit cards. The point here is over on the right-hand side. The last 2 months, people have been paying down revolving credit because they're not spending as much. That's the beauty of what's going on right now. Again, people have the means. They're just choosing not to spend at this stage. And 2 months in a row is pretty rare. This data goes back 10 years. And if you see, the only times that we had where they paid down was when we were receiving checks from the federal government. So it made it easy to pay down debt. So this is pretty rare. Again, once we get past this uncertainty, money tends to burn a hole in Americans' pockets, and they'll have stronger levels of consumption in the quarters ahead once we get past this uncertainty, is our view. Another interesting thing that we see in terms of consumer spending, this is 70% of GDP. This chart here on the left is measuring the year-over-year change in consumption. The interesting point here is that it doesn't always go into the negative territory when we have a recession. Fact is, the only times it does go into the negative territory is when we have extreme movements in availability of credit. Just starting on the right-hand side, the most recent recession, well, that had to do with the pandemic, so that's extreme. But the global financial crisis right above 2010, a lot of banks went out of business. Credit was cut back. That's why we saw the negative movement. In the dot-com recession before that, it didn't go into the negative territory. In the early 1990s, that was when gas prices increased significantly, and there was a sharp pullback in terms of credit extension back then. In the 80s, that's back when the government changed the tax laws. They moved from credit card interest payments used to be tax deductible back then. Then it became taxable. Not deductible, and that changed the views. The ones before that, you didn't see much of that movement. That's not been an important part in terms of driving an economy into a recession. What became an important part is the second biggest component of GDP, and that's investment. Investment traditionally people think of as, building buildings, building factories, building homes. And you can see it's highly cyclical based on demand and especially interest rates. But this component has been changing quite a bit of late, showing that the economy is not nearly as sensitive to interest rate movements as it had been in the past. The chart on the right, the top right, it just shows the percentage growth of the major components that we have within the investment. In the top right, you can see that building of structures, which are buildings, or buildings of homes, which is residential, hasn't changed much over that long period of time. But look at the other areas in terms of intellectual property and equipment. And with equipment, that's mainly information, such as computers, computer chips, those sort of things. That's the growth engine of the investment part. The bottom right shows how that part has changed. If you look at the top left, the green and the gray, that's the building that's highly sensitive to interest rates, the building of either structures or residential. Back in 1960, that was 85% of this. Now it's only about 30%. The areas of excitement is with intellectual property, which is like software and information equipment. That's the growth area. That's the reason why this president and the previous president have been focused very heavily in terms of trying to grow this part of the economy in the United States in terms of money going to chip manufacturers and so forth. So it is an important part. And what makes it more important is the fact that that means that the economy is less sensitive to interest rate movements and less likely to go into a recession compared to the past. And we expect this to continue to grow. On the left-hand side is a survey of CEOs in terms of their view of the economy 1 year out. And the last 2 months, it has started to move back up again. It got past the news in terms of what the tariffs were. They weren't as bad as what was being talked about, and it's starting to move up. But the more important thing is business spending, or CapEx. The expectations for growth is much higher for the next 2 quarters than what we have seen in the past. And it's the areas that you expect, all tech related. Microsoft is going to be buying and investing in 3 Mile Island to get more energy. That's a big deal. They need it. And that's one of the growth areas with utilities. Also, energy as a whole, information technology, and even discretionary spending. Those are the categories where the Wall Street is expecting big growth in terms of CapEx or business spending in the future. Again, helping to drive economic growth, because a lot of that has to do with those sectors. But of course, the wealth created there creates more opportunities for the rest of the economy. So in terms of the economy, we're not expecting a slowdown, or a contraction, just a slower pace of growth. This is abnormal. Normally, this economy grows at 2 to 3% as a recession, then pops back to 2 to 3%. So 1% growth is something that's rare, but it's easily set up for the fact that, again, we're expecting stronger growth next year, mainly because of cutback in regulations, lower interest rates, and money burning a hole in consumer pockets. As for the Fed, as I mentioned, Powell has signaled they've shifted their views a little bit. It's still contentious. There's some members that are quite hawkish. They're more concerned with inflation. Inflation is well above the 2% target. The unemployment rate is quite low at 4.2%. So they're saying, why are we cutting interest rates? But then there's the other camp that wants to cut rates as an insurance policy to prevent the risk that all of a sudden the labor situation may change. So we'll see how that plays out, but it will probably be determined based on whatever the labor report is that comes out next Friday. So our outlook, as I mentioned, is that the new budget has been established. People know what their tax rates are. Interest rates we expect to continue to decline. Regulations will decline. And the increase in the corporate investment. And that's what should drive growth to be at a much stronger level next year compared to what we see this year. So that's it right now. So what I'm going to do is turn it over to Joe, and he'll give us an update on what's going on with equities.
Great. Thanks a lot, Paul. And just to sort of echo Paul, I want to thank everybody for being on the call. I know it's the Thursday before Labor Day. Most of us would rather be fishing or doing something else. And sort of in that light, I thought it would be fun, instead of to do just a regular equity update, talk about a new framework that we're looking at, our thematic equity framework. The only thing you really need to know about equity markets right now is that they continue to hit peaks, one day after the other. And contrary to popular belief, Taylor Swift's engagement to Travis Kelce is not a market-moving event. And so with that, let's dive into thematic equities. So our goal here with this new framework is to come up with transformational forces that are reshaping the global economy beyond traditional sector boundaries. And what does that mean? That means there are long-term trends within the global economy that affect the way that we work, the way that we live, the way that we socialize with each other, where companies from multiple sectors work in coordination with each other to achieve those goals. And through this framework, what we want to do is look at some of these longer term themes and identify the companies which are adding value over those over the long term to accomplish some of these things. The advantages of thinking like this is cross-sector integration. So themes unite companies from multiple sectors, right? These companies are working in coordination with each other. There are cross-sector boundaries here. We have a longer-term orientation for some of these themes to play out. So yes, we do think about economics and the markets like Charles and Paul talked about over the next couple months. And we think about what companies are going to perform well in terms of earnings. But there are also these longer-term secular trends in the way that the global economy is moving that we don't want to lose sight of. And then there's growth opportunity identification, right? So what are the companies? We want to target the companies benefiting from these structural changes. So let's walk through a couple of these themes. I thought it'd be fun to give insight into the 9 themes that we think of when we do this. So the first is probably intuitively obvious to everybody: artificial intelligence. This is a theme that we've been talking about for the last couple of years. Companies which adhere to this theme develop, enable, or significantly benefit from AI technologies. And to give you some examples, companies that fit into this theme include semiconductor companies like NVIDIA, real estate companies like Equinix or Iron Mountain or Digital Realty, which establish the data centers in which the servers are housed to perform all the AI technologies. Power companies such as Vistra, which is an independent power producer, which produces power to power the data centers. Gas utilities, natural gas companies are used to generate the power as well, right? So here's a theme which permeates many different sectors of the economy. We know it's a theme that's going to be pretty bright into the future. Companies are heavily investing their CapEx into building out this theme, and it's something that we don't want to lose sight of. And we also know clients have been asking about it and want to talk about it. The next theme that we're going to talk about is human longevity. So what can you do to sort of extend the human life and also improve the human quality of life, right? So we want to live longer, disease-free, be able to do more with our bodies over longer periods of time. It's not only biotech and pharma companies, drug production companies, but also medical equipment companies, technology companies, which are developing new techniques for identifying problems that can be solved with early intervention and so forth. Cybersecurity, companies providing critical security solutions for digital infrastructure, data protection, and cyber threat protection. So as the global economy becomes more interconnected electronically, and there are more systems which are networked together, there are also more opportunities to attack those systems. And so we believe that companies which prevent against those attacks and enable the efficiencies of sort of cross-border networking are companies that we'd want to look into and identify. Our next group of themes, a sustainable planet and green revolution. Here you have your sort of green planet companies, your clean energy companies. The key word here is sustainability. So companies driving the global transition into sustainable energy. We want to look at here. So companies that reduce the amount of waste or help recycling. Companies that produce clean energy, such as NextEra. A lot of EV companies, electrical vehicle companies, which reduce pollution, we look at as well. The next theme is blockchain and fintech. Here we look at blockchain companies or companies leveraging blockchain technology, digital currencies, and financial technological innovations to transform banking, payments, and value storage systems, right? So there are a bunch of benefits to blockchain. It's transparent. The consensus mechanism doesn't really need a banking system behind it to transact. The government has been friendly towards these companies in the current administration. Yes, it is transparent. That's a pro and a con, right? You don't really. I'm not sure if, for example, you'd want your wife looking at you buying Coldplay tickets for your girlfriend. But on the real benefit here is cross-border transactions, right? So, for example, emerging markets in Africa, in Asia, in South America, where they don't have access to banking systems, they need a way to raise capital, do projects, and bank. And blockchain and fintech is enabling those emerging markets to be able to access capital and then produce, engage in projects that they would not be able otherwise be able to engage in. Military and tactics. Here we look at companies developing cutting-edge defense technologies. So defending your borders is always going to be a theme. Sort of the global military landscape is going to be a theme as well. I don't think we really need to go into the history of Ukraine and Russia and what's happening in the Middle East. That's something that Charles covered. But these types of conflicts, are just sort of human nature as people vie for global resources, and this is going to be a theme that we think that will persist into the future as well. Our final group of themes: physical economy and infrastructure. These are companies creating, upgrading, and maintaining critical infrastructure that enable economic growth and urbanization. So what are your typical physical infrastructure companies? Those are your utilities, power transmission companies, telecom towers, rails, marine ports, airports, toll roads, pipelines, basically all physical infrastructure. And those companies can lie in different sectors of the economy. Some of them are energy companies. Some of them are transport companies. Some of them are telecom companies, as you can see. And so following the theme that lets for the construction and production of physical global infrastructure to improve life is something that we want to follow as well. And they can fall in many different sectors. Robotics and automation. Companies developing robotic systems and automation technologies that augment human capabilities. So this is sort of one step further than just AI. This is in augmenting human capabilities in a number of different ways. And so you can see here that we have a couple of different examples. I put Tesla in this bucket. Companies can appear in more than one bucket if they generate enough revenue in those different buckets. But we think of Tesla as more than just an autos company, more than just electrical vehicles company. It is really a robotics company, right? They're working on autonomous driving. What do you need for that? You need all types of robotics and vision technology to be able to map out different routes, to be able to react to your environment. Intuitive Surgical is a company which builds, Da Vinci machines, as they're called, to aid in surgery, right? So this is they build medical robotics, and if you've traveled recently to a city which has those sort of cute little rolling robots around the street, which deliver food and beverages, and you can use for ordering food. We look at those companies as well. So sort of across the robotic spectrum and automation spectrum, this is a way that people are enhancing lifestyles and changing around the globe. The new age consumer, this is the final category that we're looking at. These include companies capturing value from changing consumer preferences, right? So there's a number of different ways that we've sort of changed from consuming entertainment and beverages and even personal electronics And so this spans that gamut, right? So for example, Netflix, we now stream movies. We all remember what happened to Blockbuster. They were offered the opportunity to engage in that business. They declined. And I haven't stepped into a Blockbuster in maybe 15 years. Obviously they don't exist anymore. Amazon, I don't really need to talk about Amazon drone delivery and the innovations that they've been doing there. The logistics that they've been building out. Non-alcoholic beverages is sort of a new a segment of the market that has been growing very quickly, as has sort of vaporless tobacco, and then Apple and other personal device companies, Apple, Samsung, companies that have been developing smartwatches or smart devices or things that we carry around with us every day. No more of those Zach Morris cell phone days. We all have tiny devices that we all carry around to communicate with each other. I can watch any movie or listen to any song I want to on my phone, So these are ways that the consumer is changing as well. So through these different 9 themes, what we want to do is track long-term secular trends. I'll skip to the next slide. Long-term secular trends for value creation. And of course, we're not going to lose sight of what's happening over the next couple of months and how economics are changing and what we think company earnings are going to be. But we also don't want to lose track of these trends. We're very excited about the themes that we've created, the way that we've classified companies across these different themes, the opportunity to talk to clients about why we think these themes are important, how we think they're going to persist, and how we identify companies that enhance value, and particularly how companies from different sectors collaborate with each other to create a better environment across the globe of how we're all going to live, work, and socialize with each other. So I thought it would be fun to go over this thematic framework instead of the typical, equities overview, and I'll turn it back to Rachel for any questions that you may have.
Great, thank you. Just checking my audio is okay now.
All good.
Yep, you sound good, Rachel.
Great, thanks. And we actually did get a comment through the chat that there is a Blockbuster in Bend, Oregon. So apparently there's one left. But a quick reminder for the audience here, you can submit in the Q&A console. We have quite a few questions that have come through already. Charles, I'm going to start with you. We got a couple of questions, but one specifically that I think stood out, if there's going to be larger spending on defense in Europe, how do you expect this to impact GDP for the region? Does it make it a good time to add exposure? What are you expecting there?
Sure, absolutely. And I think it's the question of the day. And we really did start to warm up more to international than we had been for the previous 8 years. We saw some of those growth statistics coming through last year, but then a lot of the volatility we had in politics kind of threw us off the scent there. But if you look at what's happening in the current environment, what's driving especially European equities is defense and its financials. Defense stocks in Europe are now trading at a price to earnings multiple of about 27. So that's really high. We think that spending is going to continue because of the pledge to GDP that European nations have made. So if you break that down, about 3.5% of that pledge must be spent on military equipment. I think there's upside for the European economy for that. But I also think a lot of those dollars are going to be coming back into the US, because where do you go to buy military equipment? You primarily go to the US. The other 1.5% that they're going to be spending as a component of GDP is directly related to defense infrastructure, right? And so that is going to be helping the European economy, broader global economy on an infrastructure basis. And at their own GDP level. So I think this is a really nice tailwind. I think the theme of defense in those markets has maybe gotten a little bit overdone. But just like AI here, I think it has the potential to filter through to other sectors. So it is something that we're warming up to and we think could continue.
Great, thank you. And that's insightful. You mentioned themes. So actually another question, Joe, coming back to you. What makes thematic equity investing so compelling today as you just went through those themes?
Yeah, I mean, it focuses on long-term transformative trends that are shaping the way that we work, live, interact with the world, interact with each other. These are long-term secular themes that are going to persist and enable companies across many different sectors to collaborate and work together. And what we don't want to do is lose sight of those longer term themes while we're looking at sort of shorter term earnings expectations for these companies. Right now, I mean, we see AI is pervasive across all different places of the economy, clean energy as well, with clean energy credits, the benefits you get for building a green building, for example. Cybersecurity, I mean, any one of us who has taken a flight in the last 2 years know how important that is. And so it's just a time when the world is coming together in terms of how it's interconnected, in terms of the economy, in terms of technology. And this is a great time for us to start thinking about how those themes are going to evolve and think about what companies contribute the most to those themes going forward.
Great, thank you. Paul, it sounds like we're having a little tech issue with your camera, but there's a question that came in through for you about the labor market. So there's been a lot of discussion about the tech sector specifically, especially sitting here in San Francisco. We get a lot of commentary that the tech sector labor demand has softened. That combined with federal worker layoffs, how does that contribute to our views about the labor market going forward?
Yeah, that's a good question. The tech sector reports into what's called information, and that's about 3 million workers in the United States, and it peaked a couple of years ago, but it's been relatively stable for the last 2 years. The thing is with that, although there was some headlines about companies having layoffs back then, those people quickly went to work for banks or retail places because their demand for tech workers has grown so much as shopping habits have changed quite a bit, where it's easier to click than to go see things. So they continue to stay employed. It's just they're in a different category now compared to where they were in the past. As for the government workers, that made a lot of news in the first quarter of this year with either layoffs or people taking early retirement. Those that are taking early retirement, that'll show up in the September report, which will come out in the first week of October. And the estimate is that it's going to be somewhere around a total of about 200 to 250,000, which represents a little bit more than 0.1%. So the unemployment rate, all else being equal, would go up from 4.2 to 4.3, for example. But the bigger issue there, I think, is the fact that an awful lot of research people have also been laid off. And that's up around another 100,000 or so. So that's also an issue. But other than that, there's really no other areas that we're seeing a drop in the need of workers.
Great, thank you. Appreciate that. A couple other questions coming in around the Fed rate cuts. So Charles, I'm going to bring this back to you. Do you expect that the Fed rate cuts are already priced into the market? How do you think the market's going to respond? And then another question's come in about how this is impacting mortgage and other rates consumers are facing.
Yeah, two great questions. So I think starting off with the Fed, I think a portion of it is priced in, but we've had so much volatility in market expectations. And what we watch is the term called Fed Fund futures. They move around so much and they're really not good predictors. So I've seen the market be much more measured in the way it sort of interacts with what the Fed can do. So what I'm seeing is, yes, a high probability of a September cut. I think the 50 basis point cut idea coming out of Jackson Hole is kind of off the table. But I do think part of it is priced in. But what's not priced in is what Chair Powell could say in September. So if they cut 25 basis points and they come out and they say, we're going to get more aggressive because we don't like the unemployment information that we're seeing and we think inflation is under control, I think that's going to set the markets off with a tailwind. So I could see us going into September being stable at these kind of levels, 6,500 on the S&P 500, and then getting some dovish comments and having that push us up potentially to new highs. So I don't think it's all priced in. So I think there's a reason to stay in this market for the Fed. The second component of your question, with just mortgages and housing and how that's all filtering through, look, lower rates are going to be positive for housing. And right now, supply is increasing. It's very difficult for especially first-time home buyers to get in there. Mortgage rates on the 30-year side are still north of 6%. And so to get that market moving again, we're going to need lower rates. So it's going to be a positive on the margin. You're still not going to see the sub 3% type of rates that we got pre and immediately post-pandemic. So I think it's going to help a little bit. It might help buoy some of the consumer spending that we're seeing. Certainly, it takes some pressure off of consumer balance sheets if you start looking at credit card delinquencies and some other characteristics out there. So I think interest rates are definitely going to be a net positive if they do move a lot lower, and that could certainly help that sector.
Thanks. I think we have time for one more. A couple of questions, Joe, I'm going to pass this to you, have come in, and we've heard it this week. NVIDIA reported. We'd love to hear any commentary that you have on their earnings and guidance.
NVIDIA. All right. Why does anybody care about them? They're only 8% of the benchmark. I would say their earnings were pretty strong. Their core compute number didn't really grow quarter over quarter, but networking was strong. They beat on gaming. Gaming was also is also a small piece of their overall revenue. What I would say is that the current numbers don't include any sales to China, meaning that they were given an order to stop selling to China. That order was then reversed, but you can't just flip a switch and just start selling again. You have to open up those supply chains. So there is additional revenue that we do expect them to earn the following quarter as they start selling their H20 chips back in China. Their expectations for next quarter were around 54 billion in revenues, and to put that in perspective, that is exactly what the market wanted to see. But in their heart of hearts, the market was really hoping they would say 60, even though that wasn't the official forecast. And so there was some a little bit of perceived weakness on that. The stock was down, 3-4% after market yesterday and pre-market day. It's since bounced back. It's down, less than 1% today. So I would say NVIDIA is doing what it's supposed to do. There might be a little bit of softening as they spend CapEx to build out some infrastructure, but I don't think the AI theme is going away. And they certainly haven't missed earnings, if anything. The company's been strong.
Great, thank you. So that wraps us up here. A couple of questions came in on receiving the slides. Just a reminder, you can download them here on the system. But thank you everyone for joining us. A brief survey will pop up in your console. And if you could please share any feedback, that would be helpful. We actually do read through all of your comments and questions, and any suggestions on future topics would be great. A replay of this session will be available within 24 hours, and you will receive an email letting you know how to access it. So thanks again for joining us. Have a great day and a great weekend.
Thanks, everybody. Have a good Labor Day weekend.